This week on Moving Markets, Fitch has downgraded Malaysia's sovereign rating from A- to BBB+, a move that comes at a cost to the government. FGV has been long plagued by mismanagement. Could privatization be the answer? And two of the hottest tech IPOs of 2020 hit the market. Fitch Ratings has downgraded Malaysia's sovereign rating from A- to BBB+ with a stable outlook. The lower rating is still investment grade, but it's critical that Malaysia doesn't fall below that threshold because it might impact the country's finances, since it could raise borrowing costs. Plus, it also sends a signal that the country's finances are in a weaker position than before. Unsurprisingly, there was a knee-jerk reaction on Monday, whereby the ringgit depreciated to 4.08 against the greenback, although it has since recovered to the 4.06 levels. The Ministry of Finance told BFM that it is disappointed by the downgrade, but confident that Malaysia will be able to return to a path of consolidation. However, the last time Malaysia saw a sovereign rating downgrade, it took 6 years to achieve that important reversion. And does this then mean we might see the other two international rating agencies, Moody's and S&P, follow suit? FGV, one of the world's largest plantation companies, has a history of mismanagement. But now, Felda, its largest shareholder, is making a mandatory general offer to take the company private. As for why, well, we know Felda has been trying to restructure itself, a task that would be more difficult to do so long as FGV remains publicly listed. Plus, the structure of Felda and FGV is rather convoluted. Because of a lease agreement between the two, Felda owns over 70% of FGV's plantation land, but FGV owns and runs the operations, which includes the palm oil mills. And Felda has said it intends to terminate this land lease agreement, which expires at the end of the year 2111. On top of that, FGV has been greatly underperforming. It went public in 2012 at 4.55 ringgit per share, but is now only trading at about 1.30 ringgit, the price at which Felda is offering to buy it out. For long-time investors in FGV, the buyout would mean a significant loss, considering the share price is currently at about 240% lower than its IPO price. But this could be the better option for FGV shareholders, since there would be less uncertainty regarding future operations if that land lease is indeed prematurely terminated. Even though in that case there would be compensation paid, which could be as much as 3.5 to 4 billion ringgit. Plus, FGV did post losses in 2018 and 2019, with poor operational performance of its plantations, not helped by questionable investments and massive impairments. So the bittersweet offer could just be the best way out. December is usually a quiet time for IPOs, but since nothing has been quite normal in 2020, we're seeing a number of high-profile tech companies go public this month. On Wednesday, the US's largest food delivery company, DoorDash, soared on its first day of trading, closing up by 86% above its IPO price of $102. Investors seem to be looking past the losses and stiff competition, focusing instead on the fact that it is a beneficiary of the pandemic. The other blockbuster IPO this week, though, has been less of a COVID-19 winner, and that's Airbnb. The home-sharing platform did draw much interest in its early days as a travel industry disruptor. But the asset-light hospitality company does face regulatory risks in various cities due to concerns over unwanted tourist influxes or rising housing prices. Plus, Airbnb is a victim of its own success. Today, there is less difference between Airbnb and other hotel chains, since it now attracts professional hosts who turn their properties into designated listings. While it began as a pioneer in the sharing economy, could Airbnb soon lose its edge? For now, though, markets still like the concept and the fact that it is a hybrid of technology and hospitality, which explains why its share price more than doubled on its debut, giving Airbnb a valuation of over $100 billion. And that's what's been moving markets.